Welcome back to the Daily Crypto Roundup. And if you're listening today, there's no getting around it. The last 24 hours across crypto markets have been rough. Bitcoin has taken a sharp hit. Ethereum has lost ground it really didn't want to give up. Altcoins have been dragged lower almost across the board. And leveraged traders have paid a heavy price as volatility returned with force. But as always on this show, we're not here just to react to red candles. We're here to understand what actually happened, why it happened, and what matters next. Because despite how violent the move has been, this wasn't some random collapse out of nowhere. It wasn't an exchange failure. It wasn't a protocol blowing up. And it wasn't a sudden regulatory ban. This was a classic risk-off move, amplified by leverage, driven by macro pressure, and accelerated by technical breakdowns that fed into each other very quickly. Now let's take a quick look at the current prices. Bitcoin is trading at $84,165. Ethereum is at $2,752. BNB is at $848. XRP is sitting at $1.77. Solana is at $116. Tron is at 29 cents. Dogecoin is at 11 cents. Cardano is at 32 cents. Bitcoin Cash is at $552. And Hyperliquid is at $31. Before we get into the individual stories, let's take a step back and look at the overall picture. Over the past day, crypto has moved in lockstep with broader risk assets. As Asian markets opened, Bitcoin began slipping, and once key levels were lost, selling intensified rapidly. Ethereum followed, then Solana, XRP, Dogecoin, and eventually the entire market was caught in a cascading move lower. Liquidations started piling in, stops were triggered, and by the time Europe and the US were fully active, a huge amount of damage had already been done. One of the most important themes over the last 24 hours has been the sheer scale of liquidations. By most estimates, well over $1 billion worth of leveraged positions were wiped out in a very short space of time. Bitcoin and Ethereum accounted for the majority of that, but altcoins were hit hard as well. Long positions were flushed aggressively as prices moved lower, and once liquidation levels were triggered, the selling became self-reinforcing. Riya Sehgal, a research analyst at Delta Exchange, summed this up very clearly when she explained that the move wasn't driven by sustained spot selling, but by leverage being forcibly unwound. She said the decline followed a broader global risk-off move and that the data showed futures deleveraging was the dominant factor, not long-term investors dumping positions. That distinction matters, because it tells us this was more about positioning than fundamentals. This idea that leverage, rather than belief, was at the heart of the sell-off has been echoed by several experienced voices in the market. Arthur Hayes, the former CEO of BitMEX, and someone who has been navigating crypto market cycles for over a decade, pointed to macro liquidity as the real culprit. Hayes argued that the pullback we're seeing isn't about crypto itself, but about a contraction in US dollar liquidity. In simple terms, when dollars become scarcer and more expensive, speculative assets feel the pressure first, and crypto is still at the sharp end of that risk spectrum. That macro pressure has been building quietly in the background. The US dollar has strengthened, bond yields have remained elevated, and risk appetite across global markets has cooled. Crypto doesn't exist in isolation, no matter how much people want it to. And when traditional markets start de-risking, digital assets tend to feel it quickly. Another factor adding to today's volatility has been uncertainty around US monetary policy leadership. Vikram Subburaj, CEO of the Indian crypto exchange Giottus, pointed out that speculation around the future of the Federal Reserve's chairmanship has added another layer of instability. According to Subburaj, this uncertainty has made investors more cautious, particularly in riskier assets like crypto, where confidence can turn very quickly. Akshat Siddhant, lead quant analyst at Mudrex, reinforced this cautious tone from a more systematic perspective. He noted that investors are increasingly bracing for tighter financial conditions, and that expectation alone is enough to put downward pressure on prices. When quants and systematic strategies start dialing back exposure, it doesn't take much for momentum to flip. What's important to stress here is that none of this suggests crypto's long-term thesis has suddenly collapsed overnight. Instead, It highlights how sensitive the market still is to liquidity conditions and leverage. When too many traders crowd into the same side of the trade, especially using borrowed money, even a relatively modest macro shift can cause outsized moves. Ethereum has been a focal point of concern during this sell-off. As prices slipped below key technical levels, sentiment around Ethereum weakened noticeably. Some traders have pointed to the loss of support near major round numbers as psychologically significant, even if nothing about Ethereum's underlying fundamentals has changed. This is where technicals and narrative collide. Once levels break, fear fills the gap. Meanwhile, Bitcoin's role as the market's anchor has come back into focus. While Bitcoin has sold off sharply, it has still held up better than much of the altcoin market. Bitcoin dominance has ticked higher as capital has rotated out of riskier tokens and back toward the relative safety of the largest asset in the space. That pattern is typical during periods of stress, and it's something to keep a close eye on in the coming days. Interestingly, despite the broad market weakness, not every corner of crypto has been equally red. Some micro-cap tokens have seen short-term bursts of strength, largely driven by speculative flows rather than fundamentals. This kind of behavior often appears during volatile periods, as traders look for quick opportunities while larger assets are stuck in corrective phases. It's worth noting, however, that these moves tend to be fragile and can reverse just as quickly as they appear. Another layer to today's story is geopolitical and earnings-related uncertainty spilling over into crypto markets. Wenny Cai, a market strategist at Synfutures, highlighted that concerns around corporate earnings and geopolitical tensions aren't confined to traditional finance. According to Cai, these pressures are clearly influencing digital asset sentiment as well, amplifying volatility and making traders more reactive. This is a reminder that crypto has matured into a market that responds to the same global forces as equities, commodities, and currencies. The idea that crypto is completely uncorrelated has been tested repeatedly, and moments like this reinforce the reality that digital assets are deeply embedded in the global financial system. Of course, not everyone sees today's sell-off as purely negative. Some market commentators are framing this as a necessary reset, rather than the start of something more sinister. Independent crypto commentator Crypto Sensei described the move as a manufactured shakeout, arguing that the flush of over-leveraged positions could ultimately clear the way for healthier price action going forward. From this perspective, pain in the short term can be the cost of sustainability in the long term. And this is where perspective becomes crucial. Markets don't move in straight lines, even in strong cycles. Corrections, pullbacks, and shakeouts are part of how trends reset and continue. The challenge, of course, is that they never feel constructive while you're living through them. As we move through the rest of the week, the key things to watch will be how Bitcoin behaves around current levels, whether Ethereum can stabilize and reclaim lost ground, and whether liquidation pressure truly subsides or continues to weigh on prices. If leverage has largely been flushed out, volatility may calm. If not, further swings remain on the table. It's also worth paying close attention to macro signals, dollar strength, bond yields, and any new commentary from central banks. Crypto has become increasingly sensitive to these inputs, and ignoring them is no longer an option for serious participants. To bring this back to the bigger picture, today's sell-off doesn't invalidate the broader adoption narrative. Institutional interest hasn't vanished. Development hasn't stopped. Use cases haven't disappeared. What has changed is sentiment, positioning, and risk tolerance, and those things can shift quickly in both directions. If you've somehow made it this far into the episode, that alone says something about your mindset. Markets test patience, they test conviction, and they test whether people truly understand what they're invested in, or whether they were just chasing green candles. These kinds of moments are uncomfortable, but they're also where long-term investors are forged. Before we wrap up, let's do today's XRP giveaway. A huge congratulations to Moonhead, who's picking up 10 XRP, and Andre Legal, who's receiving 5 XRP. Congrats to both of you. We'll be in touch to get that sent over. And just a really quick word as well. Over half of the people who listen to this podcast aren't actually following the show. We never ask for Patreon, we never ask for money, we never ask for anything like that. But hitting follow genuinely makes a massive difference. It helps the show grow. It helps us keep doing this every single day, and it means we can keep bringing you these updates through all market conditions. So if you get value from the show, please just hit follow. It really does keep the whole thing going. That's it for today's Daily Crypto Roundup. If you found value in this breakdown, make sure you're following the show so you don't miss the next update. Drop your thoughts in the comments. Let us know how you're navigating this volatility. And as always, we will see you at the top.